Welcome back to Investing Talk Podcast.
Today we're looking at Beyond Meat.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're really dissecting a company that, it just symbolizes the boom and bust of the last few years.
Absolutely, a darling of the market. And now, well, now it's a completely different story.
It really is. It went from this massive valuation to an equity that is, basically priced for failure.
So the question for us today is this a high-stakes, maybe asymmetric turnaround play, or is it just a slow-motion liquidation?
That's exactly it. And we have to start by looking at the current reality, the bear case. And it's defined by some pretty serious distress.
Right. Let's start with the numbers from late 2025, because they are, frankly, quite alarming.
They are. The revenue weakness is the first thing that just jumps off the page. In Q3 of 2025, net revenue was about $70.2 million.
And it's down 13.3% from the year before.
Exactly. But what's even more critical, I think, is management's own guidance. They came out and said they expect Q4 to be even lower.
How much lower?
They're targeting just 60 to 65 million. It's a signal that they have very conservative, maybe even pessimistic expectations.
So management is basically raising the white flag on any kind of near-term growth. They're telling the market the headwinds are still severe.
That's right. And that weak top-line performance, it just bleeds straight down the income statement. You see this immense margin compression.
It's a gross margin.
Yeah, the gross margin in Q3 collapsed to just 10.3%.
10%? I mean, how do you even run a food company on a 10% gross margin that barely covers the cost of making the product?
You can't. It's not sustainable.
Yeah.
And it was down from almost 18% just a year ago. That kind of drop shows a complete loss of pricing power.
And with margins like that, the losses must be huge.
Staggering. A net loss of $110.7 million in that same Q3 period.
Wow.
So that leads us directly to the biggest existential threat they have. The balance sheet.
The debt.
The debt. They are sitting on massive leverage. We're talking about total debt around $1.2 billion.
$1.2 billion. And what's their cash position look like against that?
It's tiny in comparison. Just about $131 million in cash and equivalents at the end of Q3.
That's a terrifying ratio.
It's an overwhelming number. The debt is roughly 15 times their expected annualized revenue. And the problem is made worse by the cash burn.
Right. How fast are they burning through that cash reserve?
Well, in the first 9 months of 2025, they used almost $98.1 million just in operating cash.
So their runway is dangerously short if nothing changes.
Extremely short. And then you have to layer on another risk, one that has nothing to do with burgers.
The legal issues.
Yep, the legal and governance overhang. Multiple law firms are investigating them for potential securities fraud.
And why does that matter so much right now? I mean, beyond the obvious.
It matters because it crushes investor sentiment and, more importantly, it cuts off their access to capital. The investigation is tied to an impairment charge and delayed results. It just screams instability to the market.
So you can't really go out and raise more money when you have that cloud hanging over you.
Exactly. So if you add it all up, collapsing revenue, razor-thin margins, crushing debt, the legal cloud, the market's verdict is pretty clear.
The stock is trading near or even below $1 a share.
It's the definition of a distressed equity. The market is pricing in a very high probability of failure. This is survival mode, not growth mode.
Okay, that is a brutal but honest assessment. But like you said, sometimes the biggest opportunity is when the worst is priced in. So let's pivot. Let's talk about the bull case.
Right. And there is a foundation for one. We saw a flash of it, actually, in early 2025.
What happened then?
Q1 of 2025, revenue actually rebounded to $74.8 million. That was up 12.7% year over year.
So that was their first growth quarter in years, right? Since 2022.
It was. And it was driven by a surge in North American retail sales. That data point is vital because it proves consumer demand can respond.
And what's fascinating is how they did it, because it wasn't just revenue. The margins improved dramatically in that quarter, too.
Dramatically. The gross margin expanded all the way up to 28.1%.
28%.
Yeah.
A completely different world from the 10% we saw later.
It really is. And it signals that management can pull the right levers to fix the cost structure when they are focused.
So what were those levers? How did they pull that off?
It was a three-pronged attack, really. First, supply chain rationalization. They consolidated manufacturing, closed facilities, cut a ton of overhead.
Okay, that makes sense.
Second, they got a bit lucky with a tailwind from input cost deflation. The price of soy and pea protein dropped about 19%.
But the third one sounds more like a deliberate strategy.
It was a critical product mix shift. They aggressively pushed their higher margin premium offerings. Those went from about a third of their volume to over half, 54%.
Okay, I have to challenge that point, though. Focusing only on premium products to save your margins. Is that a sustainable long-term strategy when you need volume to survive?
That's the core risk. You're absolutely right. It's a strategic dilemma. They are choosing survival today over market share tomorrow.
So the bull case has to assume they can stabilize and then pivot back to lower-cost options later.
Exactly. But that whole idea depends on having enough time to pull it off.
And with that debt load, time is everything. So
Yeah.
did they buy themselves enough time?
They did, and this might be the single most important part of the bull case. They successfully refinanced their convertible debt.
Right, they got those new notes due in 2030.
Yes, the 7% secured notes due 2030. That one move removes the near-term maturity risk and gives them a 5-year runway to execute the turnaround.
Which is an eternity for a company in this position.
It's everything. It gives them the oxygen they need. They essentially kicked the can way down the road.
And that runway is so valuable because they do have something that competitors struggle to match, their moat.
Their intellectual property. The brand is strong, but the real advantage is technical. They hold 7 U.S. patents on non-heme, plant-based muscle fiber alignment.
That's the secret sauce.
It is. It's the tech that gives their burgers that superior texture, that bite, that mimics real meat so well. Independent tests, I think, from Roush Labs showed an 83% consumer preference for their texture over competitors.
But again, if the product is that much better, why are sales falling so hard? Doesn't that suggest the problem isn't the product, but the price, or maybe the whole market itself?
That is the billion-dollar question. It tells us that the moat, while real, isn't strong enough on its own to overcome the pricing and demand issues. The bull case hinges on them fixing the cost structure first so that the superior product can finally win at a competitive price.
Okay, so they have the IP, they have a 5-year runway. What about short-term liquidity? Can they actually fund the restructuring?
Surprisingly, yes. Despite the massive long-term debt, their current ratio is strong for a distressed company. It's around 4.5.
So $4.50 in short-term assets for every dollar of short-term liabilities.
Exactly. That gives them the immediate flexibility they need to operate without having a fire sale on their assets.
So let's bring this all together. We have a stock price for failure, but with real IP, a proven ability to expand margins, and a 5-year runway. What moves the stock from here? What are the catalysts?
The single dominant catalyst is the Q4 2025 earnings release. That's expected late January or early February 2026. This isn't just another earnings call. It's the moment of truth.
And what are investors looking for specifically?
2 things. First, gross margin stabilization. They have to prove that Q1 wasn't a fluke. And second, and this is the big one for survival, a clear and credible path to becoming EBITDA positive.
Let's just define that for our listeners. What does EBITDA positive mean in practical terms for their survival?
It means their core operations are generating enough cash to cover the day-to-day costs. It's the point where they stop burning cash from operations. Hitting that milestone is the absolute minimum condition for survival with that kind of debt.
And given where the stock is trading, any sign they're on that path could cause a huge move. This thing is so volatile.
It's a classic high beta stock, about 2.5. It moves way faster than the market. We saw a 35% surge in 1 week recently on basically no news. It was just speculative short covering.
It snaps back like a rubber band.
It really does. And the technicals are all over the place. There was a golden cross back in April of 25, which is normally a very bullish long-term signal.
But the picture now is much tougher.
Much tougher. The stock is trading way below its 50-day and 200-day moving averages, but that also highlights the mean reversion potential. The further you fall, the bigger the bounce can be if you get any good news.
Which brings us to expectations. The bar is just set incredibly low.
It's on the floor. Analyst consensus for full-year EPS is a loss of over $2. So when expectations are that de-risked, even a tiny beat like we saw in Q3 can cause a huge percentage gain in the stock.
And the market isn't looking for perfection, just a sign of life.
A sign of stabilization. And one last signal to look at is what the insiders are doing.
All right, the CEO, Ethan Brown, he bought shares back in March, didn't he?
He did. 20,000 shares. His first buy since 2022. Insiders sell for lots of reasons, but they usually only buy for one. They believe in the company's future.
And some institutions were buying too, right?
Yeah, in Q1, we saw big players like Vanguard and BlackRock increase their positions. It suggests that even with all the risk, the IP and the high leverage opportunity are still attractive at these levels.
So what does it all mean? I mean, this is the definition of high risk, high reward.
It's a profound high-stakes gamble. They have a credible product and, crucially, a 5-year runway to fix the business. But they need flawless execution to overcome the debt and the weak demand.
So the market is pricing in failure.
It absolutely is, and that's what creates the asymmetric upside. If management can just deliver stabilization, the returns could be significant.
That's the takeaway. It's a bet on operational execution and IP winning out over a catastrophic balance sheet. It is not about growth right now. It is purely about survival.
A fascinating, if terrifying, story. For more analysis on complex stories that the market might be getting wrong, make sure you subscribe to the podcast.